I think that Apple was an inexpensive stock. It was trading for below a market multiple, got to 15 times earnings. If you look at it where it is right now, it's right above its 50-day moving average. It's over its 200-day. It looks technically as if it's poised to go higher. For this breakout. Yeah, I mean, that's what it looks like. Now, the only thing that I think can derail it is if the guidance is really weak, which I think is unlikely. I think that, you know, the market and investors have understood that we've had this tariff, that this is going to have an effect on the current quarter and perhaps on the next quarter. And if they can stick with where guidance is, I think the stock can trade higher over the next few months.
Let me ask you this question. Why should a company, okay, it's got a great brand, and I own the shares, but why do you think a market multiple is where...
It's below a market multiple.
Let me finish. Why do you think a market, you saying below market multiple, which means you bought it or you want to own it because it should be at a market multiple or above, right? Okay, so we agree on that. So why do you think a company that has negative earnings should be at a market multiple?
Well, I think
you've got the S&P growing at a certain level. That gives you your market multiple. And then you've got companies that are slowing in earnings, and particularly when their core business is slowing markedly. Why should that give you a market multiple?
I think the stock both trades on the acceleration of the China business, on the service business.
Which fell off again.
Yeah, but you got to look forward. You have to look a couple
I am looking forward. That's all
Steve,
I am looking forward.
Let's go to some numbers here, okay?
Okay.
As John said, there's 1.4 billion handsets outstanding.
Right.
They're averaging now $2 a month per unit in services revenue.
Right.
The plan now is for that to double. And there's several strategies they have to increase that. They have a 63% margin on that business versus the hardware, which is only a 30% margin. So as the services grow, we're going to see margins increase. If you look at the free cash flow of this company, it's almost 7%. They're buying back. They bought back $70 billion worth of stock last year. So they're retiring the company.
That's why the stock is where it is.
Yeah. You know what? It's a core holding for me. All right. Love the company. The ecosystem, the financials, the balance sheet. I think it's a cash cow that should be a core holding in everyone's portfolio.